world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by Ohad Samet and Lex Sokolin. Ohad is the co-founder and CEO of TrueAccord, a company using machine learning, behavioral economics, and empathy to reimagine the debt collection process. TrueAccord is a fantastic example of fintech's most fundamental promise, using technology and a fresh perspective to create outcomes in financial services orders of magnitude better than traditional approaches, at a fraction of the cost. In this conversation, Ohad, Lex, and I discuss the ability of machine learning to create empathetic customer experiences, AI's ability to be creative, expectations around COVID-19's impact on consumer borrowers and the economy as a whole, and TrueAccord's performance versus traditional solutions. For all of our past episodes and to sign up for our newsletter, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Ohad Samet and Lex Sokolin. Ohad Samet, welcome to Rebank.
Thank you for having me. How's everybody doing?
Doing great. And we have Lex Sokolin also. Hey, Lex.
Hey, I continue to feel socially isolated.
Well, that's probably why we've stepped up the recording schedule to close to twice a week.
Yeah, no, I mean, I really need this. This is important to me.
Well, I'm glad we were able to connect with Ohad. I think I first came across Ohad's story and TrueAccord in 2014, which feels like a long, long time ago now. And I remember when I first heard about TrueAccord thinking that this was the future of the world and how everything was going to work. It seemed like such a forward-thinking approach to business. Ohad will tell us the whole story. But fast forward, 6 years, and it still feels just as futuristic to me. It's a huge pleasure, Ohad, to connect with you. I think you're really a visionary founder and someone who's been working on a massive problem using amazing tools. So, Ohad, just quickly for context, can you introduce yourself and talk a bit about TrueAccord?
Yeah, for sure. I started working in startups a decade and a half ago now, always in machine learning for fintech. The first company I worked on was called Fraud Sciences. We did machine learning for fraud prevention in e-commerce. I was one of the early employees. We got acquired by PayPal in 2008, so I worked for PayPal and then left. And a few of my projects turned into companies. One of them was called Analyzed. It did machine learning for consumer credit underwriting, and that one got acquired by Klarna. And through that, I became Klarna's chief risk officer at the time. Klarna pay after delivery company and now global powerhouse in payments was focused on the European markets and needed help with fraud prevention and underwriting and so on. And I learned when I was there that historically we would just focus on underwriting, on making the fraud decision and so on. But there's a whole world in servicing, because especially with credit granting, the current snapshot, when you underwrite the consumer, it's about the current snapshot in the foreseeable future of their finances. But the longer the credit line lives, the longer external shocks can come into play, or just things that happen in people's lives. And if you don't service debt, either performing and non-performing, you just don't meet your numbers. And I approached it like any other problem you would approach as a founder, as a technology executive. I tried to incorporate technology and found my vendors very resistant. And this was the first time that I heard the common saying, people collect from people, meaning only humans can do this. And I knew it to just not be true, because subject matter expert based machine learning or expert-based systems have been around for a while at that time already. We're already starting to do a better job than experts on the vast majority of cases. It just felt like a problem that, like other problems that I've seen solved with machine learning, could be solved. So when it was time for me to start another company, I looked around at the ideas that I had, and just rethinking debt collection seemed like a very exciting direction. And it felt like consumers and the market in general were moving away from the old way of doing collections. I mean, consumers weren't picking up the phone. Regulators didn't like the way collections was being done, and we're going to regulate that away. That was in the early days of the CFPB. So regardless if the industry wanted to change, it had to change. And so if we could build something that would be better than the way the industry did it, collect better, but do that also with high customer satisfaction, we'd be able to capture a large percentage of the market and really drive change, both from a business perspective, but also societal change. Treat people better, treat them like customers, retain relationships, and so on.
I think the reason that TrueAccord is such an amazing story and one that resonates so deeply is because you're effectively using technology, in a sense, in its purest form, to do a job that traditionally humans have done, and only humans have done, and that traditionally has been a challenging job, and one that I think, broadly speaking, has kind of been unpalatable, both for individuals, for the industry. Like what we're talking about here is individuals who haven't paid their debts, and those debts needing to be tracked down and collected. And you not only bring technology to bear here, but I think very importantly, and I think we can get into this, through technology, you create a more aligned, more positive, more constructive relationship between lender and borrower, and actually trigger a bit of positive human psychology around helping individuals want to pay their debt back, as opposed to, continuing to fight, hide, seek to escape, which solves a hard problem in financial services, which is this fundamental misalignment in many senses between lender and borrower. And it does it in an elegant way, which prioritizes the humanity of the borrowers. I wonder if you could talk to that, specifically that question of empathy created through technology, and why technology enables you to create that level of empathy, whereas the human-to-human relationship didn't.
Yeah, this is a great question. It's the crux of why our solution works. I tell my team often, you can work in startups for decades and never work on capital D disruption. A company that really does something that really disrupts things, that lives rent-free in the head of its competitors, that changes something fundamentally. And I'm happy that TrueAccord is something like that. I mean, dry cleaning is important, and ad optimization is important. Those are things that happen in the world, but we're focused on really making a difference, and we're proud of the work that we do. And we also, this is one saying from Jeff Bezos that stuck with me, we're also willing to be misunderstood for a very long time. And I think we're seeing a resurgence in understanding why we do what we do and why it's important now among the tech community and the investment community. It's not that no one has got it. I mean, we raised venture funding, and we have a lot of clients, and we're pretty big. But it's gratifying to see the thinking changing, and people starting to accept that this is an important piece of the puzzle. This is a long setup to talk about the issue, and the issue is that there is a misperception of people in debt. And, not to put you on the spot, but I think even in how you describe this now, there's a little bit of a misperception. We often think of consumers in debt specifically, or people in debt in general, even if it's an SMB, as one of two things: villains or victims. Right? If they're victims, they're being harassed by the debt collectors. They should be left alone. It's a horrible experience. And if they're villains, They never intend to pay. They're hiding. They are, unscrupulous, or in some way, had a bad intent from day one, or they have bad intent right now. And the reality is that it's a mechanism that is very prevalent in our economic reality. It is something that every consumer is exposed to. And when consumers don't pay, it is often because of an externality, a divorce, losing their job, someone sick in their family, especially in the US, where the healthcare system is so different than anywhere else. They had a personal issue that they didn't anticipate. And many times when they don't pay, it is because they just don't know how to approach the problem. They're being attacked by multiple calls, by multiple contacts. They don't have an easy way to match their cash flow to their actual obligations. The UX is pretty bad. So, we think about this as you go to your doctor and the doctor says, hey, guy, you are overweight and you have to start working out or your cholesterol is going to kill you. And you go to the gym, and in the gym, there's a gym trainer, and the job of the gym trainer is to help you get your act together and come daily and work and lose weight and be healthier and so on without alienating you. We think of ourselves as that gym trainer, right? We don't judge you and we don't want to alienate you. We want to work with you and we want to help you work towards that goal. And we want to do that in a way that will make you actually successful through technology and through the ability to give you that customization and tools to feel agency in the process of dealing with your debt. So that's the overarching approach of how we think about this that is different than what we've seen before. And when you look at the traditional industry, the reason they have a hard time doing this is misaligned incentives. Many times, this misconception that I was talking about how you perceive people in debt is prevalent in the lending teams themselves. They feel that people who don't pay them intentionally. That drives sometimes what they expect of their partners in servicing the non-performing debt. And there needs to be a back and forth saying, look, here's the data and why this works. So there's a lot of convincing that we need to do. Sometimes that you don't need to be aggressive in order to collect, and here's the data. And the other element is that traditional collection agencies are basically telemarketing campaigns. They hire people for low base, high commission. They give them a list of phones. They call those phones a lot, and their goal is to get the consumer on a cold call and convince the consumer to pay as much as possible on the call, or they don't make their goals. The collectors don't make their goals and they don't hit their targets, and maybe they don't make enough money to feed their family that month. You can understand that under the best circumstances, this is not a good model. Right? This is a model that encourages aggressive behavior and encourages abuse and is high friction. And indeed, towards the end of every month, you see the number of complaints spike because collectors who are stressed about not making their goals start harassing consumers on an individual basis. And that is the issue. Backward technology, legacy systems, misaligned incentives, they all create a really bad ecosystem that you need a lot of energy to eject yourself from and to rethink. And this is what we bring.
Really compelling story from the social dynamics and the product perspective. And I want to generalize it kind of one level up into a question that I think was very bright maybe a few years ago, and I don't know if it ever got resolved. And so you've been a machine learning AI practitioner in finance for quite a while now, earlier than many. And so for sure, I have encountered this question, which is can AI be creative? Can it be emotional? Can it do the work of emotional labor? And a lot of folks over the last decade have said things like, you can use technology and digitization to automate processes and make things more efficient, i.e., deterministic systems. But that's not going to replace the human relationship between a financial advisor and their client, or a lender and the borrower. And it's really, there's this barrier for human work, and arguably, the space you are in requires more emotional labor than any of these other traditional examples. And yet, it sounds like the core of the engine is, multidimensional math and algorithms. And so can you tackle and maybe chew a little bit on this question of, do you think that AI and machine learning will be, in a general sense, competing with people for these sort of like very human jobs? Or is there something different about how, who's creating it or how you approach it that puts that question to the side?
I think it really depends on the sector. I think we've seen people talk to Alexa or their Google Home like a family member. So I think that's absolutely conceivable. I would not say that our application is similar to that. Specifically for us, look, we have a call center. It's mostly a customer service center, meaning we don't call people aggressively. It's mostly about people who call in or email in. They handle about 4% of our overall resolutions, meaning the people who actually resolve their cases on their platform. And that's a percentage that obviously is shrinking, has shrunk over the years, continues to shrink. So there's definitely a human element where someone is saying, I need to talk to a person. I need help from a person. I need to be handheld through the process. They talk to people who are well compensated and specifically trained to help them with their situation. But the reality is that for the vast majority of cases, at least in our world, and I think in financial services in general, people don't really want to talk to people. They want to feel understood. They want to feel like they have agency, meaning they can control what's going on. They want to be contacted through their channel of choice and to the time of choice, on their time of choice. More than 25% of our engagements are at times when you're not, from a compliance perspective, allowed to have a call center contact people. Late nights, weekends, when people are free to think about it. They wanted to do it from their device of choice. More than 85% of our traffic is from mobile devices and tablets. They want to be in control. And specifically in that, they don't want to be judged. And so when we talk about machine learning and how it's implemented and how it learns from the experts, first, our basic assumption is we are not trying to trick people or manipulate them into paying their debt. We are trying to give them the best user experience possible for them to act on their innate desire to pay their debt, which is, by the way, shared by everyone. Nobody wants to be in debt. Again, this goes back to the villains versus victims dichotomy, which is absolutely incorrect. People don't want to be in debt. And so we start from giving them the best user experience and we customize it based on their responses. And yeah, machine learning has proven again and again that it is much better than humans at providing data-driven, scalable, repeatable treatment for the vast majority of happy path use cases. Right? So if somebody wants to set up a customized payment plan, if somebody wants to negotiate and so on, these are things that can be understood and structured and be delivered in a consistent way to a vast majority of people. And the other thing that we say, Heartbeat, we have a patented engine that makes all these decisions. It doesn't get tired. It doesn't get hungry. It doesn't get angry. It doesn't fight with its significant other and takes it out on the first person they talk to in the office. It doesn't get rattled on the phone if the person in debt, who themselves can be very aggressive and in a distraught situation, trying to deal with debt, tells them something, out of line. And we keep forgetting that as humans, we have biases and we have our pitfalls. And that is why machine learning is able to replace a vast majority of human-to-human interactions that are around financial exchanges. Absolutely.
I mean, that's just such a bright point because I'm also I don't want to analogize necessarily, but like I think this is one of the points that's massively misunderstood, and there's a kind of a Luddite reaction against AI, either because people are afraid of the more bespoke or white glove or sort of emotional work that they do, and they don't want to lose their roles, or they just think of it as a machine that's calculating, and so everything's just if this then that type of function. And the creativity and the scalability of machine learning approaches into all sorts of these emotional tasks. I mean, we'll see more and more of it. Just one more question on this point, which is, you mentioned the 4% of the contact center. And also you've mentioned that VCs and other constituents are understanding the theme more. Have you seen what has been the progression over time of people really grokking that this is a meaningful approach? Like, what's the trend?
I haven't really plotted out necessarily a trend because I don't view my job as a CEO as just spending time with investors all day long and seeking, trying to optimize in my valuation and raising more money. I think CEO's job is different. So, I don't have my finger on the pulse, but I can tell you that every time I went to the markets and said, hey, we're thinking about raising money, here's how we're doing, the reaction has been broadly more and more accepting. Maybe it's a TrueAccord thing, right? Maybe it's about being the leader in a segment. People saying that's true, that the leader in each segment pulls ahead because it attracts the most funding, it attracts the best talent, and so on. And I think that's true, and we're seeing that. But having said that, there has definitely been an immediate shift post-COVID. I think the watershed moment was the first stay-at-home order in San Francisco. I think overnight, almost, it felt like I would go into a room, or a virtual room in this case, and say, "This is what TrueAccord does," and people would just nod and say, "Yes, we absolutely understand what's going on." And I think one, it's just change of public perception of our situation and now looking at a recession. And two, an interesting thing with recessions is that they mostly introduce people who have never been in debt to being in debt versus pushing the subprime population deeper in debt, because subprime consumers have always been in their own mini recession. So I think that also hits closer to home, and people start understanding that it's something that's relevant to maybe them or to a family member or so on. So you talked about empathy. I think the empathy has spread more, and I think it's very healthy in general.
Can you, Ohad, talk a little about, you mentioned COVID-19, you mentioned the current situation. Can you talk a little bit about what you're seeing immediately and how you expect this to impact your business?
Yeah, so from what it looks like from the outside in, just reading reports in the industry, it seems like the vast majority of lenders gave very aggressive payment vacations to debtors, to consumers who hold lines with them, while at the same time really limiting credit as much as possible. And the third element here is that stimulus checks came in and people have actually used them to pay debt. I mean, we've seen an explosion in debt payments in the past month, and I expect that to continue even, for a while more, especially because unemployment is more than 100% replacement of minimum wages in many states in the US. So I expect that to continue to some extent, and I think lenders have seen that as well. So everyone is kind of in a wait and see situation. But this is not going to continue forever. Unfortunately, I mean, we're in the middle of a recession. I wish that was not the case. As we reopen countries, we'll discover that demand has really receded, not because people were at home, but because they feel a lot less confident about their financials. and people have lost their jobs, and that is going to severely impact our ecosystem in general. For us, where we're going to see this first and foremost is in a shift to digital with our current clients. I believe I can't talk to specifics with clients, but we're definitely hearing, hey, my call center based servicers and so on are just in very low capacity. It's impossible to manage a large call center working from home, or very difficult. We're going to divert more volume, more work to you, which is step number one, part of their business continuity plan. Step number two, as those payment vacations start to roll off in Q3, we're starting to see a lot of demand for early stage treatments to help consumers think about default management and how to stay ahead of their credit lines that are performing. And probably call it 3 to 9 months from now, we'll start seeing an explosion in post charge-off servicing and collections. And all the while, we'll see consumers asking for help dealing with multiple debts with other aggressive collection agencies and stuff like that. We try to touch each and every one of these aspects of the consumer's experience in debt collection.
This is quite the opportunity for you guys, right? I mean, it's like a lender who launches in a bull market and then deals with the downside of a recession. The situation is kind of the opposite for you guys. You've been operating in a benign environment largely, I think, since you launched, and this is potentially a phenomenal opportunity to make a huge impact, not just for your customers, but for as you say, an increasing number of people who are working hard to repay debts.
Look, our North Star metric is according to the CFPB, 77 million consumers each year in the US that debt collection touches, that are impacted by debt collection. What percentage of those consumers' interactions do we touch as TrueAccord through one of our products? Our goal, of course, is to reach 100. We want to be able to facilitate people's peace of mind and ability to handle their debt when they're ready in a way that works for them and gives them agency and makes them successful. We're definitely not in 100%. But I even before COVID hit, investors would ask me, or people would ask me, how are you thinking about the growth of the company? We've been growing in a very good clip because we're not 100% of the debt market, or the debt collection market. And even in high times, people unfortunately fall into debt because stuff happens, life happens to us. And so yeah, I mean, if you ask me, I would rather not have COVID. I would rather not have a recession. If I could if I could snap my fingers and make this all go away, I would. But given that it's here and people need help, absolutely, we're available. We're growing. We're helping more and more financial institutions, consumers that come directly to us to deal with this incredibly unpleasant situation.
Can you talk a little bit about the? You mentioned one of the key metrics you track, but some of the other metrics you track and how your performance compares to some of the traditional approaches to debt collection?
Yeah, absolutely. Without getting too technical, in early stage collections, you think about your cure rates, meaning what percentage of people just pay their amount in default, the outstanding amount, and go back to just paying on their performing loan or credit card. You also measure roll rates between buckets, meaning what percentage of people just continue into later and later delinquency and eventually into charging off their accounts. And there we've seen tremendous success. I mean, a 50% drop in roll rates, meaning just basically 50% of people who previously would go into later delinquency have not, and 20 to 30% improvement in cure rates. So vast majority of these people have been going back to paying their debt on time. That's pre-COVID. I think that's going to change now, but generally that's just compared to business as usual and with some of our clients that have worked with us there. In late stage collections, we compete with those traditional servicers. The two ways that we're measured is one, in what's called liquidation rate, the dollars collected out of dollars placed post charge off, and the complaint rate, how many people complain. Interestingly, not on NPS or CSAT, although it's something that we measure. And in liquidation rate, we've seen liquidation rates 50% higher and sometimes 7 times higher than the benchmark. Meaning, if if a regular collection agency would collect 10%, we would collect 15. If they would collect 50%, we would collect 75. And complaint rates have been a fraction, probably less than 1% of the number of complaints that a traditional agency would get. And when we say complaints, I mean, it's even someone sending an email and saying, I didn't like the way this email sounded. We take this very seriously. Really, customer care and user experience are top of mind for us. So it's been tremendously successful across the board. And with COVID, it's going to really accelerate.
One way to think about what you're doing, and this is maybe a little bit boiling the ocean, but I kind of think about, there's lots of premium services to help wealthy people deal with their financing and with their finances and planning and all, trust structuring, all that stuff. And that's where Wall Street was focused. And the first wave of fintechs brought a lot of that down to the mass affluent or the retail segments, where you're looking at lower minimums, but still primarily planning for the future and retirement and how best to get to a goal and stuff like that. And then now we also have folks like, they're different companies, but Chime and Moneyline and all this sort of like embedded credit stuff, which is helping people who are still liquid, but are trying to extend their spending power maybe when they shouldn't. And you're helping people who are in more trouble than that, right? So who are sort of one credit quality step down from there. And I guess I have 2 thoughts. One is the social problem, right? That the average American has whatever it is, less than 2 weeks of savings or $400. I'm not sure what the number is. And then the corollary that the answer from most providers has been credit. Just give people more ways to borrow, and that's going to be the answer. So, what is the magic sauce for sort of solving the broad economic issue? Is it financial literacy? Is it planning? Like, what do you do? Because it's a really difficult issue.
It is. Look, first, to clarify something, when you look at what the previous recession basically created or really boosted up the debt consolidation industry. Anyone from Freedom Financial through Lending Club, Prosper, all of these loans went to debt consolidation. And when you think about who took those loans, those were not 570 FICO payday lending, or maybe they were borrowing from payday lending as well, but people without a job and so on. We're talking about people at 650, making 50 to 75K a year, trying to consolidate their loans. Credit and debt are a lot more prevalent than people think, and debt collection impacts a lot more people than people think. It's just there's a lot of shame connected with it. I like a saying, I forget who said that. I think it was Justin Can from Lately Had Aturim. He said, first-time founders obsess about product, second-time founders obsess about distribution. So I'm not a first-time founder, and so I obsess about distribution. And I think that a vast majority of the issue here is that there are many, many good ideas for helping consumers deal with debts, not through borrowing more, but through thinking about their budget, through thinking about what to pay first and last, how to measure cash, how to interact with collection agencies, what to do when they get a summons, how to protect from a garnishment. A lot of issues that we don't necessarily think about on a daily basis, and that actually some very smart people have tried to help with. And their problem is that none of these business models, because we're talking about consumers with not a lot of money, can support paying tens of millions of dollars to Facebook to acquire consumers at scale. Distribution is the issue. How we reach those consumers with those great ideas is a big issue. And that is where we enjoy an advantage, because as counterintuitive as it sounds, TrueAccord is now a brand for consumers in debt. Consumers in debt who are faced with servicing by TrueAccord, they're not happy because they're in debt and it's a horrible situation to be in. But they can research us online and they can say, oh, these guys are serious. These guys have 4.8 stars on Google, believe it or not, right? They will likely treat me fairly and I should engage with them. And that starts from them saying, well, if I have $1, I'm going to pay TrueAccord and not those two other, jerks who are harassing me on the phone. And it continues into them saying, well, I like this experience so much. Maybe TrueAccord can help me with the other facets of my financial existence. And, we're not the only ones in this position. There are others that maybe have that exposure to consumers who can use help, but we're definitely one of the only ones, maybe the only one, whose DNA is centered around helping consumers deal with debt from a process perspective and a relationship management perspective. And so we think that our ability to help consumers and reach them at scale without having to pay Facebook to communicate with them gives us a competitive advantage just to build those relationships going forward and help consumers with a lot more than the individual debt we were servicing.
If we take a step back and think about the broader implications of COVID-19 and the recessionary environment that we're entering, I know, Ohad, you, I think prior to a recent CFPB restructuring, did some advisory work with them. I wonder what you're thinking about, what you're looking at as you see the approaches that the public sector is taking to helping support consumer and small business financial positions into this recession, and what metrics you're watching in terms of how this recession plays through and what the eventual impacts on consumers are.
I don't think anyone is going to argue with the assertion that this is going to be devastating for at least a couple of years, and that nobody really knows the extent of the damage yet. We don't know what's going to happen once businesses open up. We don't know how much of the drop in demand has been because of the stay-at-home orders and how much of it is because of the concern about contracted COVID-19 or becoming a lot more traditional and defensive with your finances. We don't know any of that. And I'm thankful that I don't need to make those decisions on public policy because a lot of them seem to me impossible. It makes complete sense to me that policymakers are being very defensive and trying to limit damages and limit negative evolutions while waiting and seeing. For example, many states have stopped lawsuits in debt collection. I'm talking from my perspective, right? But stopping lawsuits in debt collection, stopping wage garnishments, a lot of motions that makes complete sense, right? While we try to figure out what's going on. I would be hard pressed. I think anyone would be hard pressed to say this is what's going on or this is what will happen, other than say there's a huge damage to the economy. And as we start reopening, we'll discover how bad it is. I personally am tracking loan provisions at large financial institutions, credit line utilization, credit line availability, new card issuance, and default rates and roll rates across the reports from public companies and other reports to just understand what's going on. What's their repayment behavior like? How are consumers acting? We are only in the first act of this thing. We do not know what the second act, or we don't even know how the first act is going to end and what the second act is going to include. On the optimistic side, on the hopeful side, I think that from a startup or from a fintech perspective, this shock will clean out a lot of distractions, a lot of focus on, in my opinion, unhelpful, kind of lending or helping people spend situations, and we'll focus on smart people on helping people save, helping people manage their finances, helping people manage their debt. And I welcome that. I think we need more innovation there. I think we need to think about the subprime population in the US and how we help them. I think we need to figure out check cashing. I think we need to figure out an alternative to payday lending that is more effective for consumers. I think we need to figure out a ladder of structured financial products that allow consumers to build credit and build their financial position. And just by virtue of many, many, many people, unfortunately, being in a situation where they do need help, I think we're going to see a lot of innovation. And I'm really excited for that. I gave a talk about that a few years ago at Bank Innovation. I really recommend that people read The Unbanking of America by Professor Lisa Sevron. She was also on the Consumer Advisory Board. There's a lot to be learned. There's a lot to do. And it's exceptionally interesting. By the way, third resource, the fintech newsletter from Andreessen Horowitz, also a really good source to look at. There are smart people there. Alex Rampell, Angela Strange, that you want to listen to, thinking about this problem a lot and thinking about possible solutions.
Excellent. Well, Ohad, again, a great pleasure to connect. You and TrueAccord do amazing work. Congratulations on everything you've built so far, and all the best going forward. I think we're going to look back in a few years and have watched you guys continue to rise. Lex, thanks for making time. Thanks for joining. Always good to connect.
Absolutely.
Ohad Samet and Lex Sokolin, thank you very much for joining us today.
Thank you for having me.
Thanks for tuning in to Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast. Join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.